second year. So now I'm up 40%. 60 from 100 is 40. Divide that by 2 years, it's 20% rate of return. Pretty good, right? Anybody want to sign up for that, if I can guarantee it? Well, let's take a look at what money does. Let's start out with $1 million. Let's go up 100% to $2 million. We'll go down 60%. That means we lose $1,200,000. That leaves us with $800,000. Therefore, we have a $200,000 loss on a 20% gain. That means you have to earn 150% just to get back to the $2 million. What are the odds of that, folks? So, do it yourself. Why do they tell you could do it yourself? Because they can sell more products. Gee, if only I had a better product. I had a better mutual fund. Wealth erosion's problem number 2. This is the big one. This is what distinguishes us from everybody else out there. You are unknowingly and unnecessarily losing money in the way that you pay for your house, your mortgage, how you fund your retirement, how you pay for college. Everybody's got a circle of wealth, and everybody's circle of wealth wants to do what? Grow, get bigger. Some are bigger than others, some are smaller than others, but we all want it to grow. And what most people know about is lifestyle money. How many people want to sign up so I can tell you how to reduce your lifestyle? No one. So what do most advisors try to do? Well, we're going to talk about your accumulated money. You've probably heard this. How much do you have? Where is it? Well, we could do a lot better. Just give it to us. What a bunch of horse hockey. Well, nobody can do better. But here's the big one, transferred money. This is where you're unknowingly and unnecessarily losing. So I'll give you a great example. You make $500,000 a year. You save $100,000 a year. You focus your attention on getting an extra 2% on that $100,000. That's $2,000. What if we could find 1% that you're eroding from your own wealth on the remaining $400,000? That's $4,000. That's twice as much at no risk and no cost. These are the ways that many people will lose. The biggest one for a lot of us is retirement planning. That's the very biggest one. Problem number 3, inflation and risks. Let's talk about inflation because it's the third sure thing. The first 2 are death and taxes. This is real. 1980, the stamp was 15 cents. Today, 44 cents. Anyone think stamps are going down in price? Problem number 4, the Dalbar gap. Dalbar is it's a research organization in Boston. They look at every single investor, large and small, institutional, private. They look at people who are professionally managed, people who are do-it-yourselfers, people who are day traders. Here's what they found. If the S&P 500, which is the best proxy for how the markets do, does about 9%, the average investor is doing about 2%. Oh, did you see that the market timer is doing a negative 1%? So what makes us special? Let's see if I can get this going. Thanks. 7%. That's what I think you should be getting. An additional 7% that you're not getting. That's the Dalbar gap. Just be the markets and you will get that extra 7%. It's simple. Here are the best stock pickers in the world in the red. They are the best stock pickers in all the mutual funds, hedge funds, private equity managers, and so forth, compared to the Center for Research and Security Pricing, CRSP, the CRSP model, which talks about just being the markets. If you started with $100,000 back in the 70s, you would have lost almost $1 million trying to beat the markets with the very best stock pickers. Can't be done. So do you think last decade was the lost decade? Anybody here invest in the stock market? Has anyone here invested in the stock market? Right. Anyone here made a lot of money in the stock market? Anyone lost maybe? Maybe even? That's because stocks were flat. But look at all these other different asset classes. And it gets better. A conservative portfolio, $100,000 in 2000 would be worth today $170,000. It's only a 5.5% rate of return. Not very powerful rate of return, but look how Look what the moderate does and the growth does, but uh-oh, what happened to the aggressive? Because the aggressive lost 40% a couple of years ago. Over a 20-year period of time, the aggressive would be much further ahead. So let's do a 5-minute checkup. I hate to disturb you. This could be a little painful. Everybody write down the number of years they've been working. Please. This is look, and I'm going to tell you, this is a quickie financial CAT scan. There's only 2 possible outcomes. Both of them are good. You'll either learn that things are really bad. When would you want to know that? Or you'll learn that things are really good. When would you want to know that? So let's start. You've been write down how long you've been working. Then I want you to write down how much you've earned approximately on average the last 5 years. Don't do $97,223. Put down $100,000. Now, multiply the 2. What's that number? What's that number? So you're working 20 years and making $100,000 a year in the last 5 years, that's $2 million, right? Now I want you to also write down underneath that, and don't share this with anybody, it's private, confidential, how much you have in the bank. Not how much is in your house, not how much is in your office building, not how much is in your medical practice or dental practice, how much you got invested. Then I want you to compare those 2 numbers. If they make you sick to your stomach, you got a problem. Okay, so here, top secret, it's not your fault entirely. And we're going to reveal now what we're going to reveal now will severely impact the profits of the bank and Wall Street, but will create major improvements in your own personal profits, and here's how. Here are the 3 keys. You ready? Number 1, it's not about the club, it's about the swing. Yeah, you need the club to play the game, but it's about the swing. All they're trying to do is sell you a new club every single year. Anyone here play golf? How many putters do you have? And can you use a driver in the sand? Can you use a putter to hit the ball over 200 yards of water? Can't be done. Wrong club, wrong swing. And the pundits will tell you that personal finance is a game of chess. It's complicated. I'm the most brilliant guy. You got to come to me. It's awesome out there. I got it. But I'm going to tell you it's more like a game of tic-tac-toe. All you have to know is know the rules. Simple, but not easy. Key number 1, powerful swing thought, be the bank. Don't be the victim of the bank. Don't be the customer of the bank. Same thing as the victim. Be the bank. Key number 2, eliminate the opportunity cost. Here's a quick one. You ready? 35-year-old person buys a $250,000 term life insurance policy. 30 years. He will have spent, over that period of time, $35,000, $800 a year for 20 years, and another $1,300 a year for the next 10 years or something like that. $35,000 for $250,000 sounds like a good deal, right? But if you only assume a rate of return of 6% for this person, which is pretty conservative, the last 30 years have been about 11%, so let's assume 6% in the next 30 years. The opportunity lost is $157,000. But wait, at 65, does this person now have life insurance? It's term, it's gone, it's over. Does the opportunity cost stop? It continues because that money is lost and lost forever. So by age 85, that 157 looks like 1.1 million. By age 100, if we're lucky enough to live there, it's $4 million. Opportunity cost is big. End the erosions, plug the holes, stop the leaks. What they tell you to do is pour more water into the bucket. Well, if you just plug the holes, if you were down to a trickle, that bucket's going to fill up. So let's take a look at this, the truth of costs. This is what the industry tells us. Morningstar tells us, you can look it up. 1.54% is the expense of the average mutual fund. They've got internal selling because they buy and sell stocks within that mutual fund. Because of that, it generates taxes. Oh, by the way, you have to pay somebody to hold that mutual fund, and it costs you money to buy and sell that mutual fund. What you pay for it is not what you can buy it for, and the other way around. Well, with us, we use a structured institutional fund. Internal selling's even lower than that. Taxes are even lower than that. Because of our power, there are no custodial fees, no trading costs. All this information is in the prospectus. Anyone ever read a prospectus? Of course not. Has anyone ever read the supplement of additional information, which has all the other stuff? Even fewer. There's a big difference. There is a very big difference. That's 4% compound over the life of your money. Because the average couple retires at age 62. Why? Social Security starts. How long are they going to live on average? 30 years. They need 30 years of money. So key number 3 is you need a simple system. And remember, simple is not easy. And I'm going to whip through this. First of all, you need to know the purpose of your money. It's not just to pay the bills. Maybe it's to leave money to your family members. Maybe it's to leave money to charity. You need to know your time horizon, your risk tolerance. You've got to have your protections in place first, your wills, your trusts, your insurances. Now, I'm old enough to remember going to a hardware store where there was a sign in the hardware store and it said, you can have any 3 things, choose 2, price, value, or service. Anyone remember that? Well, when it comes to investments, you can have any 3 things, choose 2, safety, liquidity, and growth. What do you think most investors choose? Safety and growth. 3, be well diversified. 4, be properly allocated in only the 12,500 companies that you can possibly own in the 42 countries in which you'd want to be invested. This is really big. Disciplined rebalancing. Always buy low and sell high. Always. It can be done. 6, minimize fees, costs, and taxes because they are killing you. 7, identify and stop the erosions. And those of you who are fortunate enough to have some critical capital mass, you can ascend to Summit for peak portfolio performance because we'll deliver solid growth, safely managed, and trusted advice through universal access, complete transparency, and above average investor, market-based returns, reliably, consistently, and predictably. Eliminate the headaches, apply evidence-based strategies. Doc, you know what that means. Evidence-based medicine. Evidence-based strategies. Wisdom and trusted advice. It's not about information, that's just pure data. It's not about knowledge, it matters not what you know, it matters how you apply that knowledge to gain some wisdom, and then the advice you get from that wisdom. So who are client summits? First of all, you got to be three things. You got to be serious about your money. You'd be amazed who's not. Second, you got to be responsible. I define that in a few ways. 1, happily married with children. And why is that? Because if you're going to sell dog food, you might as well sell dog food to someone with a dog, not a cat, a big dog, maybe even a kennel. And they'd rather enjoy your wealth than worry about it. Thanks, folks.